From my perspective, regional and mid-sized banks are different from the smallest community banks and credit unions, and the largest as well, most complex financial companies. During the crisis, we saw how institutions like Countrywide, Washington Mutual, IndyMac, that were outside the largest few, but not considered small, could impose stress on the financial system and costs on taxpayers. At the same time, mid-sized and regional banks generally have different structures, activities, risk profiles from the largest institutions. So I recognize, as someone who sat here during that whole period of time, was part of the Wall Street reform legislation, that no legislation is perfect, and the Wall Street Reform Act is no exception. As stockholders and our regulators gain experience with the rules, I think we can and should look for ways to improve the law. We should be open to calibration, however, in both directions, areas where protections may need to be strengthened and areas where the law may need careful tailoring to reduce costs of compliance and unintended consequences. As the committee considers whether to make changes to the Wall Street reform law, a law that many on this committee fought and bled for, I hope we can strike the right balance between reducing compliance costs without undermining regulatory objectives. That we give business sufficient freedom to operate, but at the same time ensure strong protections for taxpayers, consumers, and investors. And as our economy continues to recover and parties get through the initial costs of complying with the new rules, I also hope we can distinguish between the impacts of new regulations as opposed to other external factors that may be affecting access to credit or business performance. For me, that's the framework in which I come to these hearings and these issues with. So with that as my objectives in mind, I have a few questions for our witnesses, who I appreciate both your service and your testimony here today. Let me ask the three of you, you discussed in your testimony some of the steps your agencies have taken to tailor regulation and supervision for banks and bank holding companies within the enhanced prudential standards regime based on the different types of risks and challenges they present. And while it's true that a bank doesn't have to engage in derivatives or complicated trading operations to create risk for taxpayers on the financial system, making bad loans can be enough, obviously. The appropriate supervisory tools may be different if a bank has a relatively simple organizational structure and transparent activities. Can you discuss how your agencies take into account factors such as organizational structure and activities when making decisions about how to tailor your regulatory and supervisory standards?
I think we do, and the particular area that I'd like to focus in is in what our expectations are for risk management. There we are taking a very tailored approach to that individual institution. We're looking at their ability to identify the level of risks inherent in their business lines, what types of mechanisms do they have in place to detect and to address those issues, and to basically have a strong, independent, credible risk management function that's buttressed by an equally strong audit function and strong corporate governance. So that's a highly tailored view, basically focusing on the structure of the institution, and by its very nature is tailored.
Yes, Senator, let me I would endorse what Tom just said, and let me just add that I think this is probably true for all three of our agencies. I know it's true in ours, which is to say, when you think about what portfolio, supervisory portfolio a bank belongs in, the asset amount is the starting point. But if you see a smaller institution that's engaged in derivatives activities to a substantial degree, we will change the kind of supervision that we do at that institution and hold them to different kinds of risk management standards. But by the same token, we don't want to say, okay, so all banks at $50 billion have to meet this supervisory expectation, because in many instances the risk is just not present in any significant degree. That's a point I think all three of us were making in our testimony, is that in our regulation, by definition, something we do, we put in place, those are the rules people have to abide by. Our supervision, which is the important supplement to that regulation, is where I think we all exercise a lot of discretion in the kinds of expectations based on not just group, but individual firm profiles.
So when we have well, I'll call it private panel, I think it's next week, they would say that they feel that they are supervised in a way that is tailored in accordance with their realities of their organization and their functions?
I suspect a large number of bankers will think that we all pay a bit too much attention to them. But I think that's what you all want us to do, actually, is to be paying attention. I think when they can identify areas in which efficiencies can be gained through the supervisory process, not undermining our supervisory and regulatory ends of safety and soundness, I think we're certainly very receptive to those, and that's what we'll continue to do.
Well,
I can't guarantee you that banks are going to come and say they think we're just fine.
Yeah, I didn't expect that either, but let me, if I may, Mr. Chairman, just follow up on a different, a follow-on question. As the committee considers proposals to change financial stability measures, it's important, in my view, to distinguish between those that are aimed to reduce costs or prevent unintended consequences, which I would be inclined to support, and those that would create opportunities to evade or roll back fundamental protections. Very clearly, not every proposal I think will be pure in its motives. But there are areas where improvement is possible without undermining core regulatory objectives or effectiveness. For example, are there ways to harmonize reporting requirements or streamline reporting based on the type of activities an institution is engaged in?
There are, and we're thinking about some of them, part of them through the FFIEC, the council that all three of us belong to. Some of them we're doing with bank holding companies reporting in the Fed. The only thing I point out there, Senators, sometimes there's a bit of a trade-off, which is to say if we get more information, that sometimes allows us to have fewer examinations. And, you know, if the bank is giving us regular information on broad swath of areas, our supervisors can sit in a particular reserve bank and do an assessment which does not require them to go out, do the on-site, which takes up a lot more of the bank's resources. So sometimes the net supervisory burden can be reduced a little bit paradoxically through providing more information. Having said that, we are looking for ways to streamline all the reporting.
Mr. Grunberg?
Senator, I think there has been a particular focus through the FFIEC on the call reports and ways we may be able to identify to reduce reporting burden while still providing the information necessary to carry out supervision. I think there may be other opportunities. And just to come back to your previous question, you know, on the resolution plans or living wills, we've really made an effort, particularly for those institutions under $100 billion. The 165 plans are focused on the non-bank, the holding company operations. For those under $100 billion, it's really the bank that's the principal activity of the institution. So we really have provided tailored plans for that universe of institutions that really simplifies the reporting and planning obligation. And almost all the institutions under $100 billion have taken advantage of that tailored plan opportunity.
Thank you, Mr. Chairman. Thank you for your answers. I just hope you'll remain open to looking at all of those possibilities, because I think there is a desire by many of us to see that happen. Thank you, Mr. Chairman.